In part one of this topic, we talked about GAAP and the chart of accounts. Now we're going to delve a little deeper into the types of accounts we have and why they are important. As we'll discuss more in our chapter about closing the books, it's important to finalize some of our accounting processes at specific points in time. The most common might be at month end as well as at the end of the year. It's also helpful if you're not familiar with accounting or bookkeeping processes to get help in this regard, possibly by hiring an accountant to help you close the books at those points in time. The reason is because there are two types of account balances, and they must be handled appropriately in order for your reports to be accurate from QuickBooks. They include temporary and permanent accounts. Temporary account balances reset each period. These accounts begin each accounting year with a balance of 0. At the end of the accounting year, any balance that is in the account is transferred to another permanent account. A good example of a temporary account is a sales account. The sales account, as we might guess by its name, is used to track sales that incur during the year. We often need to refer to the total sales for a year, and this is where that value comes from. Accounts like revenues, expenses, gains, and losses are all examples of temporary accounts. After these amounts for the year have been reported, any balances left over will be moved to something known as a permanent account, such as retained earnings for corporations or a capital account for sole proprietors. These types of accounts, the temporary accounts, appear on something known as the P&L or profit and loss statement. The P&L is a report that is often looked at and requested by people within the company, as well as those outside of it, to see how the company is doing at the current point in time throughout the year. Permanent accounts, on the other hand, have balances that accumulate over the entire life of the company. In fact, in order to be accurate, these types of accounts or their values should be entered into the company file with current existing balances from whatever accounting method you used prior to QuickBooks. Of course, if you're a brand new company, this amount will be 0 and you don't need to worry about it. These permanent accounts include values such as assets, liabilities, and owner's equity. If we think about it, we can see that if we invested in equipment, as an example, the value of that equipment would not simply go away at the end of the year. It's carried over for the life of the company or until that equipment is either sold or disposed of, at which point the disposal would be accounted for elsewhere. These types of accounts appear on something known as the balance sheet. The balance sheet shows the status of the company over time for its entire history, not just for a single year or point in time. And that, I guess, from a reporting standpoint, is the way to think of it. The temporary accounts appear on the P&L, which is how are we doing this year, whereas the permanent accounts go onto the balance sheet, which is an overview of how the company has done over its entire lifetime. Now, although you may never have had any formal accounting classes, I'll bet you could already identify some of the general types of accounts that exist. These would include things like expense accounts, assets, income, liabilities, and even something called equity and retained earnings. That one's a little more technical. Everybody that knows anything about business or who has even participated as a consumer understands the concept, at least, of income, expenses, and assets. There are, of course, a lot of things that you could know about the general types of accounts, but for our purposes, knowing that there are these basic types or categories will do just fine. There are just a couple of details that I want to mention, though, and the first has to do with asset accounts. There are two different types of assets. The first is something called a current asset. Current assets are things that we have that are hopefully short-term, like cash, accounts receivable, or monies owed to us, and even inventory. We certainly hope that people pay us quickly and that our inventory does not sit on the shelf for an extended period of time. That is why these are known as current assets. And the general rule is if we plan on disposing of it within 12 months, it's probably considered a current asset. If that's not true, and if we plan on having it for more than 12 months, then it's probably known as a fixed asset. These are things we plan on having for an extended period of time, like equipment, furniture, and vehicles. Just like assets, there are different types of income as well. Income often comes from something known as COGS, or the cost of goods sold. This is how much it costs you to produce or acquire something that you sell. If you sell something in your business for $10, but it cost you $5 to acquire it, then you would have something known as a gross profit of $5, the difference between what it cost you and what you sold it for. That $5, though, may not be the only way to count how profitable a company is, because there are other costs associated with being in business other than just the cost of the products we produce. For example, if, after you take off the costs not directly related to getting the item, but also include things like overhead for office expenses and utilities, then you have something known as your net profit. The net profit on the $10 sale may turn out to be $1 or $2 after you subtract the cost of the item itself plus the cost of your overhead and ongoing expenses. As you enter information into QuickBooks, these types of calculations can be carried out automatically using accounts in the chart of accounts. We just have to make sure that those accounts are set up correctly. Now, that is definitely an overview of specific types of accounts. And I just want you to know that there are a wide variety of very specific types of accounts. But I think for now, we've probably put enough drain on your brain as far as these types of accounting details go. What's important to realize is that QuickBooks provides easy-to-use interfaces through things like forms that allow us to follow good accounting principles, including the use of more technical charts of accounts and double-entry bookkeeping, but without having to know that any of that is happening in the background. With that, we now understand the different types of accounts QuickBooks uses to record our transactions and how those accounts are used to produce specific reports that are important for our business. In Part 3 of this topic, the last part of our accounting primer, we'll explore why we love QuickBooks because it removes the need to understand advanced accounting calculations and what the two types of accounting methods are and why they are important for us to know.